Houses are expensive. That's why the majority of people buy homes using financing. That means lenders play a major role in the buying process and the housing market as a whole. In this video, I'm going to cover the basics of how mortgage financing works. I'll go over the 4 most popular types of loans and what makes them unique. I'll also explain the major effect interest rates have on your ability to buy a house. There are lots of different forms of financing, but in this video, we'll be covering long-term fixed-rate mortgages. They're the most common type for buying a home. The first step for buyers who aren't flush with cash when preparing to buy a home is finding a lender. Lenders are the financial institutions that actually provide the money for the purchase of a house. Things like banks and credit unions. You can shop around for lenders directly, or you can enlist the help of a mortgage broker. A mortgage broker helps do that work for you. They connect buyers to different lenders and help them shop for the best term. Lenders will collect your financial information and see what loans you might qualify for. If you qualify, they'll let you know what size of loan you should qualify to receive. This gives you an idea of your budget. Most lenders will offer more than one type of loan. For long-term fixed-rate mortgages, which are desirable for most buyers, there are 2 major categories: government-backed loans and non-government-backed loans. The non-government-backed loan is called a conventional loan. It's the standard type of financing provided by private institutions. These mortgages usually have more strict qualification standards, but if you are well qualified, can often be cheaper. Government-approved lenders can also provide government-backed loans. These loans are insured by a government agency, which makes them less risky for lenders. They can provide opportunities for buyers that might find it difficult to qualify for a conventional loan. There are 3 government agencies that back these loans: the FHA, Federal Housing Administration, USDA, United States Department of Agriculture, and VA, Department of Veteran Affairs. Each government-backed loan has unique requirements and can be helpful for people in specific situations. FHA loans provide financing for low to moderate income buyers. They can be a good option for first-time home buyers or those with a lower credit score. USDA loans incentivize buyers to buy homes in rural areas. For people searching in those areas, these can provide desirable terms like a 0% down payment. VA loans provide benefits to members of the military community. Things like no down payment, no mortgage insurance, and reduced closing costs. There are a few primary factors you'll use to compare loans and lenders to see which is right for you. First is the smallest down payment required. This is how much upfront cash you have to provide to receive the loan and can range from 0 to 5% of the loan's value. Related to down payment is private mortgage insurance, or PMI. This is not the same as homeowner's insurance. Homeowner's insurance is insurance coverage for your physical house. PMI is a different form of insurance that insures your mortgage. It provides protection for lenders when the down payment on a loan is below 20%. Next, you have mortgage origination fees that affect the upfront cost of your loan. These include processing fees charged by lenders, mortgage points, and third-party fees like appraisals. You also have interest rates, one of the most considered terms when financing a home. Interest rates have a large impact on the long-term cost of your loan. Most people base their budget to buy a home on the monthly payment they can handle. Because of this, interest rates also have a major impact on the budget you'll have to buy a home in the first place. If your desired monthly payment stays the same, as interest rates go up, your buying power goes down. A 1% increase in interest rates leads to more than a 10% decrease in buying power. For example, imagine a buyer that qualifies for a $400,000 mortgage when interest rates are 5%. If interest rates rise to 6%, that buyer will now only qualify for about $360,000. Even though their monthly payment would be the same, they would have $40,000 less to spend on their potential home. Interest rates can fluctuate a lot over time. One major advantage of long-term fixed-rate mortgages is the fact that your original interest rate always remains the same. If interest rates go up, your interest rate stays the same as it was when you received it. If interest rates go down, you always have the option to refinance your loan and receive that new lower interest rate when it makes sense. Those are the basics of home financing. We've covered how it works, major loan types, and some common loan terms. I hope that information helps you feel more confident next time you buy or sell a home. See you next time.